Welcome to our video on the recent crash of Silicon Valley Bank stock, where its shares fell by a staggering 60%. Silicon Valley Bank, also known as SVB, is a popular bank that specializes in providing financial services to tech companies and startups in the United States. In this video, we'll explore the reasons behind the stock's decline and what this means for the bank's future. Why did Silicon Valley Bank fail? Silicon Valley Bank saw massive growth between 2019 and 2022, which resulted in it having a significant amount of deposits and assets. While a small amount of those deposits were held in cash, most of the excess was used to buy treasury bonds and other long-term debts. These assets tend to have relatively low returns but also relatively low risk. The Federal Reserve increased interest rates in response to high inflation. Silicon Valley Bank's bonds became riskier investments. Because investors could buy bonds at higher interest rates, Silicon Valley Bank's bonds declined in value. The tech industry had been facing some challenges at the time, with increased regulatory scrutiny and growing concerns about data privacy and security. This had a knock-on effect on Silicon Valley Bank, which relies heavily on tech companies for its business. As the tech industry struggled, so did SVB. As this was happening, some of Silicon Valley Bank's customers, many of whom are in the technology industry, hit financial troubles, and many began to withdraw funds from their accounts. To accommodate these large withdrawals, Silicon Valley Bank decided to sell some of its investments, but those sales came at a loss. SVB lost $1.8 billion, and that marked the beginning of the end for the bank. Despite being the 16th largest bank in the country, Silicon Valley Bank didn't have enough assets to be subject to the extra rules and oversight. If the threshold was never changed, SVB would have been more closely watched by regulators. Here's a timeline of events. March 8, Silicon Valley Bank announced its $1.8 billion loss on its bond portfolio, along with plans to sell both common and preferred stock to raise $2.25 billion. March 9, SVB customers began withdrawing their money, for a total attempted withdrawals of $42 billion. March 10, trading was halted for SVB Financial Group stock 0.10 before the bank could open for the day. Federal regulators announced they would take it over. March 12, federal regulators announce emergency measures in response to the Silicon Valley Bank failure, allowing customers to recover all funds, including those that were uninsured. March 17, Silicon Valley Bank's parent company, SVB Financial Group, filed for bankruptcy. However, the bank's stock price is unlikely to recover overnight. It will take time for SVB to rebuild investor confidence and regain its position as a leading player in the tech banking sector. What happens when a bank fails? When a bank fails, the FDIC steps in to cover any losses and arrange for another institution to take over. Customers of the old bank may not even notice a change until their bank suddenly starts going by a new name. However, the FDIC itself can run short if numerous banks fail at once, which happened during the last recession. That's because its fund to cover deposits, which is generated from insurance premiums paid by banks, is far less than the sum of its actual deposits. Consider that as of December 2022, the FDIC Deposit Insurance Fund contained $128 billion. While the total deposits the FDIC insured amounted to more than $10 trillion. That's not as ominous as it may sound. Following the collapse of Silicon Valley Bank, this fund was sufficient for the FDIC to guarantee all depositors, even those with balances above FDIC insurance limits, access to their full account balance. FDIC insurance is also backed by the full faith and credit of the U.S. government, which typically steps in if the FDIC is overwhelmed and provides the funds necessary to bail out banks. The recent failures of Silicon Valley Bank and Signature Bank have many Americans concerned about the economy and the safety of their money. Although the government has stepped in to contain the damage caused by the bank failures and ensure account holders can access their funds, inflation and interest rates remain high, so the threat of a recession persists. Generally, money kept in a bank account is safe, even during a recession. However, depending on factors such as your balance amount and the type of account, your money might not be completely protected. For instance, Silicon Valley Bank likely had billions of dollars in uninsured deposits at the time of its collapse. Fortunately, there are things you can do to increase the security of the money you have in the bank. Is my money safe in the bank? Understand that your money is not physically in the bank. As soon as your bank receives a deposit, It gives that money to someone else in the form of a loan. By law, banks must hang on to some money, but it's not much. Capital requirements vary by institution, but according to the Federal Reserve, it's around 10% for many big banks. That means 90% of the money your account statement says is at the bank is actually somewhere else. Like with an auto dealership that sold a car to someone who borrowed funds from your bank. The bank takes deposits, makes loans and collects loan payments to replenish its coffers. Meanwhile, its 10% capital reserve supplies cash to people who close their accounts or make withdrawals. As long as there isn't a run on the bank, there won't be any problems. How to secure money in your bank account? Money in the bank might not feel safe as it used to. But there are moves you can make to increase the safety of your funds. First, only keep your money with institutions insured by the FDIC or NCUA. Nearly all U.S. banks and credit unions participate, and many highlight deposit protection in their marketing materials. Look for the logo of the respective insurance programs, or just ask a teller. You also want to avoid depositing too much money. Federal deposit insurance covers a maximum of $250,000 per owner of an account. That suggests you should keep only $250,000 at a bank, but it's more complicated than that. A married couple who jointly owns an account can deposit up to $500,000 and still be fully insured. Similar coverage caps apply to IRAs, trusts and other accounts. It can get somewhat complicated, but the FDIC's Electronic Deposit Insurance Estimator, ED, makes it easy to determine whether your deposits qualify for government deposit insurance. If you have more than $250,000 on hand, it might be wise to spread your funds across multiple banks, as to avoid exceeding the FDIC's threshold. Or you may consider opening a cash management account, as CMAs often provide FDIC coverage beyond federal limits.